Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about how to map out your 401k contribution for high income earners. So in this video, I'm going to be walking through a hypothetical couple making pretty good money, talk about some of the decisions that they may be making in terms of putting money into the traditional 401k or the Roth 401k, and some of the thought processes behind that of why you would do either one of those and how to kind of map this out over time. And just because you pick one of those strategies, Roth or traditional, doesn't mean you have to stick with that. So I'm going to be talking about that in the context of some of the changes that are going to be coming up over the next couple of years with regard to our tax code. So as I've mentioned in other videos, many of you know we currently have something called the Tax Cuts and Jobs Act rates that went into effect in 2018, but they have a sunset provision, meaning that those are going to expire at the end of 2025. And then beginning in 2026, if no new legislation is enacted, we're going to revert back to the old tax tables that we had in 2017 with some adjustments for inflation. And what that's going to mean is pretty much across the board higher tax rates for everybody. In every single tax bracket, those tax rates are going to be higher beginning in 2026. And then I'm also going to be talking about something that came out a couple years ago with the Secure Act 2.0, which was passed in December of 2022, and are starting to roll out some changes here over the next couple of years, something that's going to affect your catch-up contributions. If you're over 50 and putting in that extra money, they're going to change that rule beginning in 2026, where those catch-up contributions, if you're a high earner, now have to go into the Roth by default. So you don't get a choice on that. So let's dive right in and let's introduce you to our hypothetical couple here, James and Susan. So a little bit about them. They're 50 years old, and just to keep things simple, we're going to assume they're both the same age, so we can make things nice and simple here. And they've done very well that they like to retire early at 55, so 5 years from now. They have a combined W-2 income of $370,000, and just to make it simple here as well, we're going to assume that's pretty much divided right down the middle there between the two of them. And then they also have a very nice taxable investment account, or sometimes we call it a non-retirement account, where they've accumulated about $1.2 million in this other brokerage account with a combination of different investments and things. And then in the middle here, we have what are called non-preference items for about $30,000. Now, why did I include that? Well, some of you may know, and especially if you've watched my other videos, you may know that there are certain things that you can earn money on inside your investment accounts that are what the IRS calls a preference item. And those are going to be long-term capital gains. So if you sell an asset that you've held for longer than 12 months, you're going to get a preference rate, and it's not actually going to go into your marginal tax bracket. It's not going to be counted as that base income rate. So long-term capital gains and also qualified dividends are also going to be included in this. The things that are going to be non-preference items are going to be interest income. So if you earn interest from bonds or CDs, things like that, that is going to be taxed at your ordinary income tax rate, and that is going to be part of the income tax base, and it is going to push you up possibly into a higher marginal tax bracket based on that. And then, of course, if you have any short-term capital gains, that's also going to be a non-preference item as well. So I include that just because that's going to be part of the calculation here. So again, I try to make my math super easy here. So we're going to assume that they have $370,000 of W-2 plus those non-preference items, so $400,000 of taxable income. So let's see where they're at. And I think one of the first keys to all tax planning is really to understand, number one, what we just talked about, how your income is taxed. So you know, is it falling into your marginal brackets, or is it something that's one of those preference items? So understanding that, but then taking that and then understanding where you fall on the tax table here. So $400,000 of total income here. If we look for 2024, we can see that the 24% tax bracket goes up to $383,900 for 2024. So they're just over that a little bit, but we have to remember we get at least the standard deduction, or if we have some itemized deductions, it may be a little bit higher than that. So for 2024, the standard deduction is $29,200. So what we have here is we have the ability to have up to $413,000 $100 and still be in that 24% tax bracket. So I think that's very important to understand that and understand that standard deduction or your itemized deductions there. So at $400,000 of total income, they are still in that 24% tax bracket there. One thing we want to look at though is we want to also look and see, well, what are those tax brackets going to be in the future? And of course we want to think about things like, is their income going to be going higher? Are they going into a new job role where maybe the income is going up substantially, or they're expecting a bonus? For a lot of high income earners, you may have things that are non-cash compensation, things like stock options and restricted stock units. And as those vest, those are things that can add up to your marginal tax bracket and everything. But we can see just how big of a difference our current tax table is versus what those tax tables are going to be. What I did is I took those 2017 tax bracket and then I applied the inflation rates to that. So we can see $400,000 of income is going to be in that 33% marginal tax bracket by a pretty good amount, almost $100,000 into that next tax bracket there. So we kind of have a unique situation here, an arbitrage. And so what I would do for James and Susan is I would probably look at a strategy that, because they're in a lowish tax bracket right now, I would probably make Roth contributions to their 401k plan. So you don't need to get that income down anymore. In fact, actually, according to the table there, we might even have an extra $13,000 or so that if they wanted to do a Roth conversion or something to even kind of push that right up to the limit. So let's say for simplicity here, they just turned 50, so they would be entitled to a catch-up contribution. So they could do, it's actually a little bit more than that. It's $30,500 each for the contribution for the 401k plans, including the catch-up contribution. But just to make the numbers easy, let's say it's $60,000 that they're contributing $30,000 each there. And then they could look at doing, like I said, that $13,000 Roth conversion. I've made many other videos on that. In fact, I have a whole Roth strategies case study where I really dive deep into all those, and we'll put some links down in the description below for that, where you can learn more about that. But you always want to be looking at, where you expected to fall in the tax bracket, how much room do you have? So by doing those contributions into the Roth, they're not actually going into that next tax bracket, so we don't really have to worry about that. However, like we were talking about there, if these tax brackets revert back in a couple of years, well, if they're still making, let's say, $400,000, they're going to be hitting the 28% tax bracket and also that 33% tax bracket. So, and the reason why I made this video titled Mapping Your 401k contribution strategy is because we want to create this map. We want to say, okay, hey, again, just because we made a decision today that the Roth was the best thing doesn't mean that we should fall asleep at the wheel and just continue to do that. Because in 2026, what the strategy should be, and I actually just worked with a client here just this past week doing exactly the same thing, and fairly similar situation there where we were doing exactly this, kind of mapping that out. So in 2026, we're going to make the contribution. We're going to assume that the contribution limits are going to be the same. I know they're not. They're going to be inflated there. But $23,000 is the base contribution. So they would be able to do that times 2. So $46,000 would be able to go into the traditional. But like I said, with that Secure Act 2.0, the catch-up contributions, which we're going to assume are going to be $7,000, they're going to have to put $14,000 into the Roth because of that new rule that's going to go into effect in 2026 there. But that $46,000 is going to be coming right off of the top line of that marginal tax bracket. So if we can reduce those taxes, we could say, okay, we're in that bracket by about $100,000, but if we can put $46,000 and take that off the table, we're actually saving 33% on that right off the bat. So that's obviously a good thing. But then what is the next phase of the strategy? Well, the next phase of the strategy is going to be at age 55 when they retire. Now, at age 55, most people probably aren't going to have a pension, and if they do have a pension, that pension may not start for maybe several years. Maybe you're entitled to get the pension at 60, maybe 62 or 65. If you do have that pension option available at 55, typically what we see is that's going to be at a reduced rate. So you really want to look at that. So they're probably not going to have any other sources of income really coming in unless you had some other business income or rental property, which we're going to assume that they don't have there. So we're basically starting from ground zero there on the income front there. So what we'll be able to do is take advantage of something I've also talked about in other videos, which are going to be low tax years. And let's go back to our tax table over here, and let's look at that and say, what does that look like? And again, these rates are going to continue to go up with inflation and everything like that. But if we said, hey, let's just target the 25% tax bracket, we can have, including our standard deduction and personal exemptions, which are coming back in 2026, again, if nothing else happens, we can have $205,000 of taxable income. And that's before we go into that next tax bracket there. So in this case, what we're going to assume is they have a pretty nice non-retirement taxable brokerage account that they're going to be able to use to live off of, maybe at least for those first 5 years, so that they don't have to dip into any of the retirement savings and everything. Hopefully, if they've set that account up right, and we've got other videos where we talk about that, where you have focus on those preference item rates, so things like long-term capital gains, exchange traded funds, things like that that don't throw off a lot of dividends, and capital gains tend to be a good investment vehicle for that. And then they tend to have qualified dividend income. Some people actually build entire portfolios that are just focused on those dividend income things. But basically, if you have that set up right, they could theoretically take out $205,000 out of their traditional IRA and convert that over to a Roth. So over 5 years, they could potentially convert $1 million from their traditional retirement accounts over to a Roth and never be above that 25% tax bracket. But it actually gets even better than that. So when we say that somebody's hitting the 25% tax bracket, we really need to look at the effective tax rate. And so in this case right here, if they were to fully, I'm going to write that bigger there so you can see that, but if they fully maximize that 25% tax bracket, assuming that this inflation forecasted tax table, they would only pay really an effective tax rate of 17.1%. So I think one of the things that sometimes people miss when they're looking at traditional versus Roth 401k or IRA account is that if you take the money off the top, if you take that deduction for that tax-deferred retirement account, that traditional 401k plan, that's coming off of your marginal tax bracket. So we save taxes over here at 33% when that money went in, talking about between 26 and those last couple of years. And we save the tax at 33%, and we're going to pay the tax at 17% later. So it's almost, well, really about half, a little bit less than half of the difference there between what we saved in taxes versus what we paid in taxes there. So that's the real tax arbitrage with this strategy here, is to be able to know where we're at in our current tax bracket, what our future tax bracket is going to be, and then creating that long-term map. And so if we continue this on, age 55, eventually maybe a pension kicks in, maybe Social Security eventually kicks in. You can turn it on as early as 62. You may want to delay that. Maybe they exhaust, depending on what their expenses are, maybe they exhaust the money that's in that non-retirement taxable brokerage account, and then you have to change that up a little bit there. But anyway, I hope this was helpful to kind of get an idea of just the thinking there of the opportunity I think that we have right now with our current tax structure, what may happen in a couple of years when we revert back, that new rule with the catch-up contributions needing to go into the Roth, and then the strategy to take advantage of those low tax years in the early part of retirement there. So anyway, hope you enjoyed the video here today. If you'd like to learn more about what we do, head over to moneyevolution.com. We've got a great resource center there. We're really trying to build that out to be a a hub for all things financial, personal finance, retirement planning. So we're building out different sections that can really help you with a lot of these topics. Of course, here on YouTube, be sure to subscribe and like the videos there to help get that out to other people that may be interested in learning about this stuff. And then check out some of the links down in the description below for all of that. So anyway, hope you enjoyed it. I'll look forward to seeing you back in my next video. Thanks.